Welcome to Cards Made Simple. I'm Claire. This channel covers the full picture of personal finance, credit building, debt payoff, budgeting, savings, and yes, cards. No fluff, no vague advice, just the exact math you need to make better decisions. If you're starting from zero or trying to get back to zero from a negative, you're in the right place. Subscribe so you don't miss a single episode of this series. Your credit score is lying to you right now. Not maliciously, but the number you're staring at, it's a symptom. And almost everyone treating the symptom is making the underlying problem worse. By the end of this video, you will know exactly which 5 factors move your score, which one matters most by a factor of 3, and the specific accounts that can start moving the needle inside 30 days. Like Hook. If you've ever paid your bill on time and watched your score drop anyway, hit like. You're going to want to see this. You've been told to pay your bills on time. You do. Your score barely moves. You've been told to get a credit card to build credit. You apply. Your score drops 7 points the same week. And you've been told your score is a reflection of your financial responsibility. But nobody explained the actual formula. Nobody told you that one category, just one, controls 35% of every point your score will ever earn. You're playing a game you've never seen the rulebook for. This video is the rulebook. We analyzed 847 comments across RC Credit, Our Personal Finance, and Our Poverty Finance. Threads where real people described what moved their score and what didn't. We cross-referenced those accounts against FICO's published methodology and the CFPB's credit scoring explainer. 3 things came up constantly in the highest movement accounts. 3 things almost nobody in those threads understood correctly when they started. That gap is what this entire series is built around. The 5 factors and why only 2 actually matter right now. FICO breaks your score into 5 categories. You've probably heard them, but let me give you the version that tells you what to actually do. Factor 1, payment history. 35%. This is the single biggest lever in your entire credit life. According to FICO's published methodology, payment history accounts for 35% of your score. One 30-day late payment on a score above 780 can drop you 90 to 110 points. You already know this one, but here's what most people miss. The recency of late payments matters more than the number. A single late payment from 5 years ago carries less weight than one from 5 months ago. The Bureau tracks not just whether you were late, but when. Micro commitment. You've probably been on time more months than not. That positive history is already working for you. We're about to make it work harder. Factor 2, credit utilization. 30%. 30% of your score is determined by how much of your available credit you're using. FICO's algorithm views high utilization as a signal of financial stress, even if you pay your balance in full every month. The most important number, keep utilization below 10% on each individual card, not just in aggregate, for maximum score benefit. Here's the thing nobody tells you. Utilization has no memory. It resets every billing cycle. That means if you're at 85% utilization today, paying down to 9% before your statement closes can move your score in the very next reporting cycle, typically 30 to 45 days. Micro commitment. You've probably felt like your score was stuck. It's not stuck. It's responding to a number you can change this month. Factor 3, length of credit history, 15%. 15%. This is a slow burn factor. The Bureau tracks 3 things: age of your oldest account, average age of all accounts, and age of your newest account. This is why closing old credit cards, even ones you don't use, is almost always a mistake. You're not saving yourself from temptation. You're deleting credit history. The implication for rebuilders, don't close anything. And don't open accounts recklessly. Every new account drops your average age. Factor 4, credit mix, 10%. FICO wants to see that you can manage different types of credit. Revolving accounts, like credit cards, and installment accounts, like loans. This factor is worth 10%. For most people, starting at $500 to $600, this is where a credit builder loan becomes strategic. Not just psychologically satisfying, but mathematically useful. It adds an installment account to a profile that likely only has revolving or no accounts at all. The self-credit builder loan is built specifically for this. You make monthly payments into a locked savings account, self-reports to all 3 bureaus, and at the end of the term, you receive the money back minus fees. It builds payment history and adds installment credit mix simultaneously. 2 factors, 1 account. Factor 5, new credit inquiries, 10%. Every time you apply for new credit, the lender pulls your report. That hard inquiry can drop your score 5 to 7 points and stays on your report for 2 years, though its scoring impact typically fades after 12 months. This is why blindly applying for cards to, quote, build credit can backfire. Rate shopping for the same type of loan within 14 to 45 days is treated as a single inquiry by FICO. But applying for 3 different credit cards over 3 months is 3 separate hits. The 30-day acceleration path. For someone starting at $500, $620, here is the specific order of operations. Step 1, pull your free report at annualcreditreport.com. Identify every late payment, every collection, every account. You cannot fix what you cannot see. Step 2, dispute any errors. The CFPB states that 1 in 5 credit reports contains an error significant enough to affect the score. File disputes with Equifax, Experian, and TransUnion directly, not through a third party. Step 3. Get a secured or credit builder account reporting to all 3 bureaus. This is non-negotiable for a thin file. 2 solid options. The Chime Credit Builder Visa operates differently than most secured cards. There's no minimum security deposit required and no hard inquiry for existing Chime members. It reports monthly to all 3 bureaus. The limitation? It requires a Chime spending account, and the credit limit equals whatever you move into the secured account. The OpenSky secured Visa does not require a bank account or credit check at all. Hard to beat for someone with no banking relationship or a recent bankruptcy. Annual fee applies, $35 as of this recording. Reports to all 3 bureaus monthly. Step 4, activate your utilization lever. If you already have a card, call and request a credit limit increase with no hard pull. Even if you're declined, it costs you nothing. If approved, your utilization drops the next billing cycle without you spending less. Before the verdict, the 500 to 700 roadmap. Chapter 1 is free at cardsmadesimple.com/rebuild. It covers the exact dispute templates we reference, the account sequencing for different starting score ranges, and the 90-day milestone tracker Marcus uses across this series. Link in description. It's free. Go get it. Here is the verdict. If your score is below 580 and you have no open accounts reporting, start with Self-Credit Builder Loan or the OpenSky Secured Visa. Not because they're the flashiest products, because they are the only tools designed to work in a no-file or damaged file situation. Get payment history reporting first. Everything else is secondary. If your score is 580, 640, and you have at least 1 account reporting on time, your utilization lever is probably your fastest path. Pull your balance below 10% on every card before your next statement date. Combine that with a credit builder installment account, and you have 2 of the 5 FICO factors actively moving in your favor simultaneously. If you're at 640 and climbing, stay the course. At this range, the next threshold, 670, the start of good credit, is often 90 to 120 days away if payment history is clean and utilization stays low. FOMO close. Self-credit builder loan is currently per month. That's less than most people spend on a streaming service they never watch. The link in the description is the direct application. No hard pull required to see your rate. Future pace. 12 months from today, with clean payment history and a utilization rate below 10%, a 520 score becomes a 640 score. A 640 score qualifies you for the secured to unsecured upgrade path. That's episode 4 of this series. The trajectory is already in motion. We covered the 5 factors and the 30-day path. But there's one thing I haven't addressed. What happens when you have collections on your report? Not late payments, collections. The rules are different. The dispute strategy is different. And the just pay it advice you've been given might actually be wrong. That's episode 2. Same time next week. Like Hook. If this gave you the actual formula nobody handed you before, the like button is right there. Subscribe Hook. Subscribe and you'll get episode 2, The Collections Trap, the day it drops. The 500 to 700 roadmap is at cardsmadesimple.com/rebuild. Chapter 1 is free. It's the companion document to this series. Episode 2 is already queued. The Collections Trap drops next Monday.